I think whatever stimulus in the GST2 has been given by the government, that has worked. I think this CD ratios particular thing has come, that 6 states is more than 100%. It's okay. Overall country is fine. It's 80%, and 80% is a reasonable number. You also said one more thing, that some NBFCs, they are, which are not banks, they are also very active.
That's in commercial credit, yes.
Yes, so
they are meeting almost half of the demand.
So actually, that shows that the market is getting diversified. It's not necessary that is only the banks will do that. Private banks still continues to be a bit of more conservative. They couldn't see earlier, if you remember, they were very aggressive, but suddenly in between,
that was during the boom.
When the retail some issues happened, they became very conservative. I think they have not yet come out of that. So another reason of CD ratio coming out is a deposit is coming. Traditional deposit sometimes going out into the capital market. Off late, in last say 7-8 years or something, one more shift has happened. See, on the capital market, a credit to the infrastructure and large projects, financial institutions are coming up. So if you tell me about 10 years back, the financial institutions were about 40% of the such credit, where the banks were balance 60. Now the other way around. Now they are more than the banks. Okay, which is also very natural phenomena. It's the financial institution who should fund long-term credit. In developed countries, banks not only depends on this deposit, they raise from the market. Slowly the bond market of India is maturing, and at the same time, several sources, which you always used to say, that pension funds, insurance funds are not coming to the bond market, they are just being used by the government. It's not happening anymore. See, they are coming to the bond market. That's another reason I think this is happening.
Hi, this is PratimBose, and you are watching Podcast with Pratim. My today's guest is old friend Subhendu Moitra, investment banker. So with Subhendu, of course, we will discuss banking, finance, and economic growth. Subhendu, let's start with the basics. The banking balance sheet, if we go by any figure, whether it is World Bank data or CEIC data, so we are back to something around 2006-7 kind of, or below that, the NPA level, right? So it has been a long journey. It went for an inverted U, and it peaked to 11, 10, 12%, and then came down over the years between 2017 and 2023. So that means that bank balance sheet is clean.
That's
From
right.
here, we are witnessing that over the last couple of months, we have got good news from the economy. The latest GDP numbers are definitely too good. And considering the US tariffs and etc. And second is that we also saw that demand has picked up for small cars, which means conversion from two-wheelers to cars. We read about auto companies planning expansion of capacities from 20 to 40%. So these auto is a big pull factor in things. So that said, how ready are our banks? Because parallelly we are hearing complaints about falling margins. There was a news about very high CD ratio. So if the CD ratio is already high, how are they giving it? But this is not a universal thing, because private banks are trailing in lending rate. So up to you.
Now, there are a couple of things what you said. One is, of course, the growth, which is very important. And I think whatever, stimulus in the GST2 has been given by the government, that has worked. And so that we can see the domestic growth rate is really very high. And that's what we see, the growth rate of 8% in the last quarter, 8.2% to be precise. So other things what we are saying actually is a corollary to that, like that, because you have reduced GST, so a lot of sale of car and other things and all. And so the CD ratio in certain areas, certain states have gone up. So, CD ratio is a very interesting thing. CD ratio depends on a couple of things, of course. So if I look at the CD ratio of the developed countries, okay, it's something around, say, Norway, 175%. Okay. and then for Sweden is 150% kind of thing. At the same time, you see the ratio of another developed country, Japan, is 45%. So it depends on a couple of things. One is, how the market is working. CD ratio is a deposit and credit. So if I it's more than 100, that means you are lending more than the deposit. Now that only happens if there is a market, capital market is working, bond market is working. Those are the countries which I said, where those are very active because they are developed countries. And so maybe we are moving towards that. That's number one. Number two, if you see the particular state is going up, overall is 80%. So if you look just at Tamil Nadu, Gujarat, at Maharashtra, it's high, I agree. But also if you look at the northeast state of, say, uh, uh,
Maybe
even
Bengal.
even said, of course, a small state, Arunachal, is about 30%. West Bengal should also be around 50, 60%, 60% maybe. I'm not sure about it. And even, say, a very small state, of course, Lakshadweep is 8%. At the same time, there are states which is more than 100%, say Tamil Nadu, Gujarat, and those sort of states. So it's okay. It's okay. It's natural. Wherever there is a growth, there'll be more credit. So of course, earlier the government was monitoring this to see that if there's a balanced development. Now, balanced development is also pushed by the government. At the same time, it has its own inherent way of also development. It's not that government can push development everywhere, and it's not right also that if you
No,
push.
I'm not saying that. I mean, in a capitalist world, you cannot expect that. So the
No, but the
states,
government will do some balancing, but I'm saying you should not do so much balancing that is wrong. It keep deposit, credit where it's not required. It cannot do that. Ultimately, it will flow in the places where the credit is demanded, credit is, credible, like that. So I think this CD ratios particular thing which has come, that six states is more than 100%. It's okay. Overall country is fine. It's 80%, and 80% is a reasonable number. I think. RBI also is saying overall should be within that. Now, having said that, as you are saying, a lot of new businesses coming, new developments are coming. How the lenders are ready for that? You also said one more thing, that some NBFCs, they are, which are not banks, they are also very active in this.
that's in commercial credit, yes.
Yes, so
They
they're
are
that.
meeting almost half of the demand.
So actually, that shows that the market is getting diversified. It's not necessary that is only the banks will do that. There has to be the fintech companies. They are funding it. So it's good that new sources are coming, and new sources are coming with the new kinds of development credit and all, which is helping the economy as such. Now, I think the bank is quite strong. All the banks more or less in a very good state and with a very low NPA ratio, and
But
there
why
is.
private banks are trailing in credit?
Private banks, I would say, trailing in credit. The maybe the government banks have more push for it. Private banks still continues to be a bit of more conservative. They can see earlier, if you remember, they were very aggressive, but suddenly in between,
That
when the
was
retail,
during the boom. That was during that boom.
when the retail some issues happened, they become very conservative. I think they have not yet come out of that. It looks to me. So, and government banks have suddenly government has shifted gear from the corporate to the retail in a big way of last couple of years, which is also another reason as such that
To
private banks.
boost consumption. To boost consumption.
Yes, and
And
so
also, I believe retail credit gives them more margin.
yeah, retail credit give the more margin, it's a less risky because the amount these sizes are small, so risk is pretty small as such. So basically, as I'm saying on the CD ratio, if the banks can manage the risk, because see, risk of the high CD ratio is that if liquidity has a issue. So overall, if the bank wise, if you can maintain a proper CD ratio, I don't think there's any issue on that. On the issue of the whether banks are ready to fund such project, yes, I think they have liquidity, they can fund it. There is a problem, I would say. There is some liquidity is going out to capital market, which is also a good development. So every time there are good companies, they're not only always going to the banks, they are going to the market also to raise debt, to raise capital. So that is another good part of it. So another reason of city ratio coming out is a deposit is coming, traditional deposit sometimes going out into the capital market through mutual funds and other things, which is another reason why the CD ratio in certain areas you find. Banks are of course getting issues in getting deposit. They have to fight. Earlier it was very easy. They were just coming to them, and that it's coming. It's now a bit not that easy because the
It's a
capital
competitive market now.
the competitive market now, which is good for
The
the
mutual
for
fund
a
industry
deposit.
has grown
Investor
reasonably.
deposit is a good area as such. So that is one part of it. So I think we are in a very good stage as such in these matters. And one more thing also, let me tell you, off late in last say 7 8 years or something, one more shift has happened. See, on the capital market, I mean, a credit to the infrastructure and large projects, financial institutions are coming up. Earlier, it was only banks. Now, large financial institutions like PFC, REC, IIFCL, NAFID, they are coming up in a big way. So, if you tell me about 10 years back, the financial institutions were about 40% of the such credit, where the banks were balance 60. Now, the other way around. Now, they are more than the banks. Okay, which is also very natural phenomena. It's the financial institution who should fund long term credit, which is happening. So, and banks are giving more for a
So,
term.
so if I may interject, you are saying two things. I actually had a question that if we haven't seen much of capital expenditure in the country over the
Yes,
last decade.
yes,
So, having been so, if the CD has already hit 80%, right? Which indicates almost exhausting their capacities, because I don't think in Indian context anyone will allow them, even the
beyond
regulator will,
20,
yeah.
beyond that,
So this is the maximum limit,
yeah,
kind of. Uh, so it has already, they have already almost exhausted the headroom, right? And so, how will the projects be financed? That was my question.
yeah.
Because now, if we expect that capital expenditure will henceforth keep rising, more and more projects will come. So, who is going to fund that? But,
No, I mean,
you have one clue, of course, the DFIs.
no, I mean, DFIs also will most of the times they take money from the market and the banks also. So that's a large clue. Second thing, what happens also, let me tell you, whenever such good projects come up, the banks have another option. They sell certain retail portfolio, securitize it, sell it to the others. I mean, the basically AIFs, they are a specialized AIF, there are funds who take it over. So they create their room if they find good projects as such. Off late, as you said, good projects was not there. So they are mostly going to the retail. So they have that option of liquidity also. They have the option of raising liquidity from the bond. As I said, in developed countries, banks not only depends on this deposit, they raise from the market. Slowly, the bond market of India is maturing. You can raise money there. So that is another. That is says that CD ratio goes up. There are few reasons. One, of course, is a development. Secondly, stronger market, less risky. Third, other ways of raising money than the proper normal deposit. So this third thing is also happening. So they have an option. If they get a good project, they can always raise them. I'll tell you, I'm forgetting which country where the bank is not allowed to fund mortgage loan, which is basically housing loan, from the deposit. They have to necessarily go to the market, raise bond and do it. Because see, the mortgage loan or the housing loan are actually 50, 20, 30 years. So it's not necessary that they should take the short-term deposit and fund it. So there is a restriction that if you have 100 rupees of say,
Well. They must have learned from the subprime, right?
yes, subprime, yes, the US
So
subprime. I
you
think
are
in the
not
US
going
and Canada, I
subprime,
think
and we can also
that.
say about the ILFS crisis in
Yes.
India. So taking short-term loans and funding long-term projects.
So that there the banks are not allowed also. That we don't have such restrictions here, but in that country, so it's good that raise money from the long term money from the bonds and you know invest such projects, raise from the market, raise from the other international funds. So there are options for that. So I don't find much of issue on that in such kind of requirements are there.
You said something very interesting. You said that slowly the bond market is maturing. Now, before giving the mic to you, ever since I entered journalism, some financial journalism, some 3.5 decades ago, I've been hearing about the bond market not there, right? And we have
Right,
been hearing it. I was hearing it. I mean, even 5 years ago.
right.
So, what has changed, and since when, and how definite is the change? Explain.
See, the bond market will do better as and when the investors become more knowledgeable. As you might have seen, Earlier, everybody used to put money in the bank because that's the safest. And they will not put a capital market. They will not go normally. Now, there are people, very normal people. They said, I'll do mutual fund. Some of that understanding is there. Similarly, bond also, there are people who are investing in a, because see, you see right now, even the NPS and other kind of, pension schemes and all, they need a very long-term fixed return.
Right.
Okay. So there's a lot of even NPS has come. Other pensions funds have been also asked to put money there. So those sources are also opening. So given that those monies are also coming to the bond market, that they raise money through the bond if they have to raise long term money. They don't raise a deposit. Okay, the long term bonds and all that market, and they invest accordingly. They invest in a long term kind of papers which is being issued. Normally, they prefer the banks and government banks and all that. It becomes easier for them to invest in such things. So I would say that last couple of years with these changes in the reforms in pension sector or in overall mindset of the people and overall understanding and various intermediaries coming and regulators working better, that's one of the options. You might have seen, of course, we have not seen much of that effect. Last year, we discussed that India's bond being included in the international bond, benchmarks and all. Of course, we are yet to see much of effect of that because after that, a lot of international uh, issues are there. So
You
people
can
are
say Trump effect.
Trump effect. So people are worried on the interest rate going where and how and when. So still not happened, but that is another reason. Slowly we're getting integrated with the international market, and at the same time, several sources which you always used to say that pension funds, insurance funds are not coming to the bond market. They are just being used by the government. It's not happening anymore. So they are coming to the bond market. That's another reason I think this is happening. Last say 2-3 years, we can see this effect of this bond market, especially the banks and others raising money from the bond market. Yes.
Okay, so we have witnessed or are witnessing a qualitative change in Indian capital market, right?
Right.
It is
Absolutely.
gaining more more depth, and a good bond market means that we will have better instruments to finance infrastructure projects, right?
Exactly.
If I understand it correctly.
Yeah, and not only that, I'm not from the retail market size at all. I get a lot of people asking me how to do SIP and what is SIP, and also very common people who otherwise have not much money. So they said, should I give some 100,000 rupees or 500 rupees in SIP? Government has allowed them to invest less per month. Recently, so there is an interest which I'm very excited, and a lot of people come, especially young guys.
100%, 100%,
Young
100%.
guys,
Even in
school
social
college guys,
media,
school
in
college
so
guys ask me, sir, can I understand what is SIP, how it is invested? I very happily explain them, not the individual cases, but theoretically how it is happens. And so I mean, I feel there is a change in a mindset. Earlier in my parents' time, they will very clear: post office, banks, forget it, or LIC. That's it, nothing else. Now it's not so.
I can tell you a funny story. So one of my colleagues who later became an entrepreneur. So this was many decades ago. So we were then taking some interest in equities. Okay.
Mm.
I also come from that bank fixed
Yes,
deposit background.
we all
Uh,
actually.
we all are.
Yes.
So, but we have then started taking some exposures and we're trying to be curious. So, but my friend was dogmatic. He invests only in NSCs and fixed deposits. And as luck could be, he became the entrepreneur. We did not.
No, and in fact, there's very. I mean, let me tell you also why it has been more established. Twice, actually, I mean, it was two times. These retail investors who entered, especially smaller investors, they got hit.
They
One
suffered.
one is US 64 was the first such kind of fund where is some issues were there. Though later on they didn't lose money. Second time is the Harshad Mehta time, and after that everybody becomes so.
No, the biggest letdown was that Morgan Stanley thing.
That was also there, but I'm saying these two are common people. A lot of people invested that time in the share market, and so as soon as they found that, they realized, this is not my area, they just take my hard-earned money. So and but then fortunately now the regulations and others have come in a much better way. So I think, so again, the confidence is coming back in the market.
Thanks, Subhendu. We will meet again, and next time we will discuss about, and very shortly we will meet. Next time we will discuss about why the Indian rupees is sliding and whether that is good or bad. I mean, whether we should try to resist the slide or, I mean, this is a very natural phenomenon, and whether it is bringing us some good benefits, at least in the short term.
Sure.
Thanks for joining the show.
Pleasure.